I think it makes sense for the markets to be under pressure this morning because the figures that we had been talking about before were much lower than this, right? We had expected after the 50 billion from Friday to be talking about perhaps another 100 billion. So all of a sudden today we're talking about 200 billion with the potential for 200 billion more. So it's a lot more than what the market was working with when it closed yesterday. So that makes sense. But one thing that I think we'll end up focusing on later in the day is the fact that we still have very few details here. Right. And one of the points that Kayla was making that makes this calculus a little bit difficult is the fact that going forward 200 billion or 400 billion extra would involve a lot of products that have a direct impact on the consumer, and that's very, very difficult politically for the administration to go ahead with that.
Consumers would be paying more for if they actually slapped these tariffs on.
Correct, because up until now, the 50 billion from China were inputs, let's say, into other products, right? There wasn't a direct impact on the consumer. If we start talking about television sets and phone equipment, then you get the direct impact on the consumer, which makes it much more difficult politically to actually go through with this.
Makes it more difficult politically, but Darrell, if there's one thing that you can say the president has been very firm on and very has strong convictions on, always had for decades, it's probably this issue. This idea that America is not being traded fairly.
Yeah, very much so. I mean, if you go back in his 40 years of public life, he's waged war against any types of trade deficits. And actually, if you pay attention to what the administration has been saying for 6, 9, 12 months, they've been very direct on steel, aluminum, autos, airlines, semis, and shipbuilders. Those 6 things they've highlighted many times before. So I think they're running that playbook right now. And we're having a conversation about what auto tariffs would mean as it relates to Europe in that regard, too. We actually think that if you look at every $100 billion worth of tariffs, just as a rule of thumb, reduces global trade by about 0.5% and probably dents global GDP by 0.1%. So to Gabriela's good point, if you were to have 400 billion of tariffs executed, not just discussed, but actually executed, you're probably talking about 0.4 off of global GDP, which today is about 3.9 to 4%.
When would that show up?
Most of the latest round, the second 200, not the first 200, would be probably Q4 of this year. The first 200 is actually the 100 of 301 tariffs that just got raised to 200. So the thought was the 50 that was announced last week, was the 25%. The next 100 would be at 25%. Now you're talking 200 at 10%. So the calculus isn't that much different there, right, on total dollars worth of tariffs. If there were an additional 200, it's probably Q4 of this year.
Andres, you're a little more laid back about this. You think that this is probably still a negotiating ploy at this point?
I think so. I mean, there's no way to know exactly how this is going to play out, but I would say that based on the playbook that they've done, and I mean, you don't want to compare it, but look at North Korea to a certain extent, where everyone said this is insanity, and then actually it was negotiations. So I think it's still early to call it anything more than that. But going back to this, I guess to put some context around this, trade deficit for the U.S. is around 3.5% the size of our economy. Mm-hmm. Consumption is 69%. So I think it could affect the consumer to a certain extent. But China is not the only country we trade with. So not everything that is affected by this trade negotiation could not be replaced by South Korea, by Japan, by other sources. It clearly would affect us on a quarter over quarter basis. But I think eventually we could buy TVs from somewhere else, right? That's the way I would look at it. Having said that, earnings might be affected. One of the biggest, if you look at economic data points that's highly correlated with earnings, is exports globally. Right? So if exports globally are affected negatively over the next couple of quarters, that would affect earnings, which would obviously affect the equity markets.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.